good morning, good afternoon, good evening, wherever you are in the world. So I'm Brett Waters, and this is a panel discussion on no bad blood, due diligence for startup founders and investors. So I've been in Silicon Valley my whole life. I've been a founder and I've been an investor. Today I teach entrepreneurship at Stanford University, and I run the Fourth Lee Startup Accelerator. So due diligence is part of every fundraising cycle. And investors need to know everything they need to understand about a company, and founders have an obligation to disclose everything, the good and the bad. And if you follow the story of Elizabeth Holmes and Theranos, you know that when due diligence isn't done properly, bad things happen and bad blood spills. And so that's what we're here to talk about today, is how does due diligence happen in a smooth, effective, and productive way, both for investors and for startup founders. And joining us for this discussion is my partner in crime, Louie Liu. Morning, Louie.
Brett, thanks so much for that awesome intro jingle. I thought that was really cool. And I'm really excited to talk today about one of my favorite subjects. And as I see it, Brett, it's before and after the term sheet. And I know you're going to tee that up. Yeah. For those of you who don't know me, I'm a Silicon Valley lawyer, and I help startups get formed, financed, scaled for growth, bought, and sold. And I believe that to be a really great advisor, you've got to be there at startup in the garage so that you can be there when the company's ready to go global. So that's Perfect. A little bit about me, Brett, and thanks for putting this together today.
You bet. Also joining us this morning is Jenny. Jenny, where are you calling in from today?
I'm calling in from Los Altos, my house, and thank you for having me on this live broadcast. My background, private company CFO for the past 14 years or so, and public companies, including Netflix. I've gone through a number of due diligence, acquisitions, and whatnot. Love to share my ideas.
Awesome. And finally, joining us is SC Moati. SC, morning.
Morning, Brett. Great to be here.
So let's see. Essie, give us a little more background in yourself before we get going.
Yes. SC Moati. I'm the managing partner of Mighty Capital. We invest at Series A, mostly in the US and mostly in technology. What's unique about Mighty Capital is that we give our portfolio companies access to a global product platform that reaches over 20% of all product managers. We're investors in companies you'll know like Airbnb, Amplitude, DigitalOcean, and many other amazing entrepreneurs.
Awesome. Terrific. So, we've got the right panel here to discuss this, right? We've got Louie, who's handled a lot of startup financings, both representing investors and also representing founders. We've got Jenny, who's been a public company CFO and private company CFO, digging into the numbers, and SC, who's was on the investing side. So as Louis said, I think you can think of due diligence as being kind of a two-phase thing. And the first phase is before the term sheet is issued. The investor wants to kind of check out and see whether or not the things that the founder is claiming are true. And then the second phase is after the term sheet. That's when we're kind of digging around in the financials and in the tax obligations and kind of looking for skeletons in the closet that need to be pulled out and disclosed. I was talking the other day to a friend of mine who's been a Silicon Valley venture capital guy for 40 years, and he was talking about how when he first joined Venrock 40 years ago, the senior partner that was kind of mentoring said, he said, the first thing you do is when you're considering investment is you drive over to the startup's office unannounced and count the number of cars in the parking lot. And see whether it matches the number of people that the entrepreneur claimed work there. These days you can't do that because everybody's working virtual these days. But I love that story about the old-fashioned due diligence. Drive over unannounced and see how many cars are in the parking lot. So Louis, what do you typically tell founders? In other words, all founders want to say only good things about their startup and what an amazing opportunity it is, and how the investor needs to just wire their money right now. So, what do you tell founders in terms of the ways to approach the diligence process?
Great question, Brett. And as we've talked about in earlier episodes of this series, I believe that we're living in a world of high resolution fundraising right now, where it's happening all the time, and it's happening very quickly in real time, and it's happening here in the metaverse. And so the various phases are before the term sheet and after the term sheet. And so the very first thing that I say to entrepreneurs as they're going out to raise is to have their ducks in a row. And the very first thing that you better make sure is working when you go out to talk to investors is your website. You would be amazed at the number of website sites that don't load, or the video that's supposed to be up there isn't there, or you have team members on there that didn't necessarily agree to be on there. So the website is the very first place that you're going to be due diligenced by an investor, and that's the very first place to worry about. And then as you go along the various stages, you're going to need to be concerned about different things. I think the very first thing people are going to be looking at is obviously your investor deck, or teaser, or what have you, and people are really looking for a gut check. How does it make them feel? And so if you make outrageous statements that don't sound true, they're not going to land with the recipient. Then, of course, after the term sheet, or after you get a meeting and you're invited back to meet the general partners of a fund, or more members of the operator collective. I want Jenny to talk about that. You'll need to really be focused on answering the technical questions that the investors are going to have about how the product works, how it gets monetized, how it's performed to date, and whatever traction metrics you can demonstrate. And then after that, I think if things go well, you might get a term sheet, and that I think we should kick to the latter part of this discussion about what you need to be concerned with at that stage. But that's what I get concerned with, Brett, is making sure that founders are really ready for each phase of the process.
Mm-hmm. Mm-hmm. So, Jenny, you as a CFO, I assume that you would advise founders to make sure the books are nice and tidy before the fundraising process begins, so that the diligence process goes smoothly. But any more color you'd add to that?
Yeah, so I, echo what Louis just said. It may not be at the top of the founders' minds, but nevertheless very important. And sometimes it's a mundane, borderline boring topic such as a sales tax, right? That becomes
Sales tax, yeah.
Yeah, not a lot of startup companies think about it at the early stage, or as mundane as US GAAP reporting. So a few companies that I dealt with, they would say, I report cash basis because I really, really hold the cash dear near to my heart. And that's all good. Tracking cash is important because at the end of it, it's a one way. However, financials need to be presented under the US GAAP, right? US GAAP compliance, accrual method, and especially for SaaS companies, how you represent your booking and revenue, those top line forecasts as well as actual, super critical.
Yeah.
And sales tax, just mundane compliance items, right? Make sure your tax returns are filed. If you have more than California or outside California, state returns are filed, annual reports are filed, right? Employment contracts, cap table is clean, all of the above. And the sales tax, if you have sales, do register, right? And sometimes it's a very mundane, not the critical item, but make sure all those documents are in place and your financials are really reported in compliance with a US GAAP report. And I've seen acquisitions or those conversations go sideways because of unknown, right? They just recently discovered that they have liabilities and whatnot.
Yeah, I think the in my experience, it's very common that early stage startups are just doing cash accounting because that's really all that matters, and you're not, depreciation tables and all the rest of that stuff doesn't really matter much for an early stage startup. But then certainly when you reach the point that you're talking to institutional investors, they're used to looking at GAAP statements, and so you're going to have to either make the effort to get those in place beforehand, or you may be scrambling at the time. And it's a good segue into the question we've got here from Amode, which is just simply, along the startup journey, when do you think a startup should think about bringing in a CFO or fractional CFO? Do you have thoughts on that, Jenny?
Yeah, I would say fractional CFO early on is good because at the early stage, even seed and Series A, they're setting the foundation, right, for scalable growth or accelerated growth. So having a fractional CFO so that you know what the next steps are, just make sure the foundation is laid properly. That is good thing. Full-time CFO, it depends. I would say instead of hinging upon a certain stage, make sure it is at the right step, right? Let's say you're hiring lots of people, then you think about HR, full-time HR, or you are gaining a lot of momentum in the market, then you think about product and CTO. When you start having two-digit millions revenue or ARR, that's where you start considering, because with the complexity in business, there will be a complexity in finance and operations and all around. And the board, you may have an institutional board member that requires certain things, right? KPIs and whatnot. So that's where you start considering. But do not rush. Always check out referrals and all that.
Right.
Brett, I was going to address that. What I see across the portfolio of companies that we work with and the businesses that I meet every day is that there are three critical problems, three legs in the stool of how do you get a startup off the ground. The first is obviously the idea. So assuming that you've got that, you're going to need a legal structure. You're going to need funds that work with the legal structure, and then you're going to need a finance function, both to entice the fundraising and to manage it thereafter. And so I can't say how important it is to partner with good advisors at the outset, and finance is a critical function. And we haven't talked about this, but in this pre-term sheet diligence phase that I'm talking about, I think one of the most critical slides in the deck is the revenue model. No matter what stage you're at, is demonstrating that to the investor that you've thought through this is going to be a big market, but also that that you're going to be a responsible steward for their money, and that over some period, maybe it's 3 to 5 years, that you've built a model, and probably it's only a very summary slide, but there needs to be a backup Excel spreadsheet that shows really how you've put it all together. And I think that's one of the important functions of this fractional CFO that you work with. Maybe you don't bring them on on a regular basis. Maybe it's just a mission, but you really do. To answer the question that Amode brought up, I think you really do need a finance function as part of your team.
Great. And SC, I want to bring you into this discussion. So, as an investor today, kind of how do you think about the due diligence process?
Yeah, for sure. So, a couple of things. One is for entrepreneurs who often think, okay, well, now that I have a term sheet, I'm gonna, sign and get funded within like a couple of days. Like that's not reality. And the reason for that, I know it's frustrating to fundraise, but at the same time, you want to have what people call smart money, like value add investors. If you think about it in the public market, you would rather have Warren Buffett invest in your company than some random, amateur somewhere in the middle of, nowhere. Well, Warren Buffett is not going to make an investment in your company unless he has done extensive due diligence. But then the value he brings is fantastic, right? It's going to bring a lot of credibility to your company. So investing in that due diligence, I think, is really worth it. The way we do due diligence, which is not, I think, uncommon, we look at 3 tracks. Business track, which mostly is done by myself and my partners, but then we do legal and financial tracks. So Louis and Jenny point is absolutely well taken. It's great to have a lawyer involved, and you have to have a lawyer involved, and then ideally a CFO as well, especially if you have $1 million in revenue or more. And then in the business side of things, every investor will be looking at different things, but really there's 5 risks that investors can take when they make an investment. There's team, technology, market, execution, and financing. Just these 5. My recommendation to investors is never take the team risk, which means that you as an entrepreneur will need to demonstrate you're an amazing team. Technology, if you're very early in your business, you may find investors who will take a technology risk, but most venture capital firms do not take a technology risk despite what they may say. And so make sure that you've kind of, checked that your technology is working and proven. Then the market risk, I think, Jenny, you alluded to that before I had to, my internet went off. You have to show that your market is big enough, because otherwise you will have a company that cannot exit. And exit for an investor is the difference between success and failure. So it's really important that it's there as part of the due diligence. Then execution is, can you deliver against your plan? Can you grow and execute? And finally, financing risk. That's especially important if you're, for example, raising a safe notes. Some investors will not do that. If you're raising using token or cryptocurrencies, some investors will not do that. And simply because for them, there are enough risks in an early stage company, they don't need to take a financing risk. But anyway, so when you think about the due diligence that an investor is doing, think about these 5 risks and then the legal and the financial aspects on top of that.
Yeah. I think that's a really good way of framing it. A professional investor really is in the business of identifying where the risks are, and deciding, when the risk is reasonable compared to the opportunity. And it's called risk capital for a reason, because capital is deployed for startups, which are traditionally a high risk asset class. But what an investor doesn't want is to be surprised later at the risks that they took on, right? They want to feel as if they reviewed all of the information, understood it all, and then they made an investment decision based on informed judgment of the risks. So, Jenny, you brought up the tax thing, and this is something that I've lived myself. That I was in the middle of a financing, and one of the things that came out during the diligence was that we had not paid sales tax in certain jurisdictions that we were supposed to, and we were like, "Oops!" And luckily, it wasn't that big a deal. We were able to simply rectify the problem, pay the taxes, and it wasn't that much money, and it was good. But an awful lot of deals fall apart because of unexpected tax exposure. So, Jenny, anything more you want to say about that in terms of ways in which founders can do a better job of making sure that they're compliant across all the different jurisdictions, and also that investors can do a better job of kind of proactively probing?
Yeah, so the timing of thinking about sales tax, let's say you're a tech founder. Let's say you don't know anything about financing or tax for that matter. But I know I need to pay, but I haven't registered. I don't know where to start or where to start, right? The best way to do it is when you start having the first paid customer, right? Which state, where they're coming from, right? And ask a finance person or tax advisor. You may have an external tax advisor. I know I need to pay something. How should I go about it, right? It's most likely a playbook scenario that, let's say you have a tax and you are in a SaaS company. Not all 50 states tax SaaS. Some do so more aggressively, some don't, right? And let's figure out which state it is. It's called the taxability study, right? But let's say I sold to New York or I sold to Illinois. For instance, Illinois does not have a SaaS tax, but Chicago does. Slightly different tax jurisdiction, right? You don't need to know all the technical, but you can ask your tax advisor or a CFO or a finance person which one I should worry about, right? And they will say, oh, you know what, certain states are very aggressive,
Right.
and just assess. So now fast forward, you're having a due diligence conversation, right? And I know I am concerned, but how do I present that? What happened in the past is the past. Like you can do that, but you need to present yourself that I got this. I'm in control, and I know my exposure is, and I can quantify this is amount, and this is my mitigation plan. My
Right.
cannonballs, guns are lined up to address this. So rest assured, once you fund me, I will get this taken care of, or it's in the process.
And
So
Jenny, can you hire a CPA firm to do a taxability study
yeah,
for you?
yeah, Big
So
Fours and
is that something that you recommend a founder do just
yeah,
to
just to assess the taxability
yeah
or the amount,
yeah
right? The
yeah
other way that I've seen is, this is what happens. We are in the middle of it and we are addressing it. However, for the entire disclosure and amount and the paid, we can discuss it, put it as a post-close item, right? I have seen that happening as well. So there are ways to get around it. It's not the end of the world. You haven't done it. Oh my God, I don't even know how much it is. There are ways to address and mitigate the risk.
but being proactive about it is always the best approach. So something like a
Yes.
taxability study sounds like
Yeah.
a good one. So Louis, here's a question coming in specifically for you. What's the most complex aspect of legal due diligence?
Um,
I guess first question, just for my understanding, is what is legal due diligence? And what are the aspects of a due diligence process that are kind of legal? Are they trademarks, copyrights, patents?
That's a
What is
great
that?
question, and I think SC really teed up due diligence, before the term sheet with these 5 areas of risk that she and her partners assess, and they do it, at scale. And so I hope founders were taking note about what those 5 risks were, and at some point along the line, SC and her partners are going to decide this is a go, and they're going to write a term sheet, and that term sheet will get reviewed by the founder, and the founders should have legal counsel, and maybe even have it looked at by their finance advisor like Jenny. And let's say it all gets agreed. The very first next step is that the investors council is going to issue a 5 or 6 page legal due diligence request list. And if you're a founder and you've set up your legal due diligence properly, you're just going to say, hey, you just give me the emails of your team, SC or investor, and you're going to go to your lawyers and give them those email addresses. They're going to light up access to a virtual data room. And all of us that practice with startups, maintain relationships and hopefully have a product for this. And we use, like many practitioners, a product called HiQ that's put out by Collaborate. And we will permission access to a data room. So that means what I'm saying here, Brett, is that we've gotten our ducks in a row long in advance. And so the very first thing that investors are going to look at in the data room is the capitalization table, and that each and every share that was issued, especially to the founders, was validly issued, fully paid, and non-assessable. And that means that there was a written agreement, and there was some consideration paid, whether it was in intellectual property or in cash. And we have a record of either of those, or both, sorry, and bank statements that foot to this. And probably, if you are best in class as a startup, you've done this with a vendor like Carta, CapTable.io is another, and there are several others, Shoebox, and I could go on. But Carta, I think it really has cornered the market on this area, and you've got your cap table ready. So that's area number 1. 2, you've got your founder arrangements set, so you know that your founders are locked in. How do you lock in a founder? Typically, they have a big block of stock, so it's big because you want to make sure your founder has some reason to stick around. And 2, that it is subject to vesting. So the investors are going to want to see that from formation, that founders are there for at least 4 years before they have the right to walk away, and that if they do walk away, the company can buy the stock back if the founder tries to transfer that vested stock, and so that you know that you've got a team in place that is incented to the long-term success of the company after the money gets there. So the founder arrangements are really important. And Brett, I think that's going to be the topic of one of our next podcasts, is how to set up your founder equity far beyond the scope of this podcast today.
Right. Right.
Then you're going to have a product, and that product is going to be rooted in some intellectual property. And that could be, in the old days, it would be a patent, and we would want to have as many patents as possible. And in modern times, in a post-pandemic world, we really want to have trade secrets. We want to make sure that intellectual property, it's not patented necessarily, but it's protected, because every member of the team has signed a proprietary information and invention assignment agreement, or a PIIAA. Sometimes it's called a CIIAA. We want to make sure that everybody understands that works for the company, whether they're a consultant or an employee or an advisor, understands that the technology, everything related to the product, everything related to the business of the company is the company's property, and that any inventions created by that person don't belong to the person, they belong to the company. So this is table stakes for legal due diligence 101. Is the very first things I look at when I'm investor counsel, and when I onboard a new company that I hope will get financing. These are the first things I look for, make sure that we've got our ducks in a row. So what are some typical problems? Well, and this can happen, in the pre-term sheet stage, but we're now in the post-term sheet stage. I look at the LinkedIn profile of the CTO, and it says he's an employee at Google. Oops. Has this happened to me before? I won't say. But at Google, this person signed a proprietary information invention assignment agreement, and I might need to see that, because maybe this product is owned by Google and not the startup. And I'm sorry, I promised my partners I would not talk about real companies. So we should edit that out. But these are critical problems.
It's a company in Mountain View that starts with G and ends with Oogle.
And then a background check. You should assume, if you're a startup, that an investor is going to do a rudimentary background check. I myself use a company called VCheck Global. It's cost effective. You might not. It's not as good as the CIA, but anything findable will be found. And you need an explanation. So if you haven't paid your taxes, if you have an arrest outstanding, if there are tax liens against your home, these are all things that will get flagged and that people will get concerned about. And SE, I think I heard her just say, we don't take team risk. Well, please take that off the table. Run the background check in advance and clean it up, because this is something that you can do yourself, or certainly your counsel or your financial advisor can help you do that. So these are kind of the early stage diligence risks that we look to mitigate. And when I'm company counsel, I'm setting all this up in a data room with folders, all the documents, so that when the investor and their counsel open up this data room, they have a big sigh of relief. Oh, it's all there. It looks very well organized and clean. So that is legal due diligence, Brett. It happens all throughout the deal. Sorry, and then once investor counsel prepares a stock purchase agreement, we'll prepare a disclosure schedule of all the disclosures that we need to make against the reps and warranties in the stock purchase agreement. So that's the final piece of legal due diligence, is making sure that those disclosures are accurate and that there are no bombs in there, no technology risks, all these risks that the investor doesn't want to take. And when we find them, to Jenny's point, we have a very solid mitigation plan. We're going to do a taxability study in the 60 days post-closing, and we have a general idea that the potential maximum risk is, X thousands. That is legal due diligence done right, Brett. Sorry, I took too many minutes.
No, it's all good. So I posted into chat for our audience a Medium article I wrote about a mistake that cost me $130,000. And it was a cap table issue, as Louis mentioned. It was I had issued some shares to somebody, and it never ended up on the cap table. And then when we sold the company, that issue came out. and I ended up having to personally make that person whole in order to have the transaction go through. So I wrote a little Medium piece so that others can learn from my mistakes. So, and I think, let me just also say it as a serial founder, that Louis' point about the CIAA is a really, really huge one. That, get those things in place on day one. Don't have anybody writing code or doing anything for your startup without having a CIAA in place. Because then, when you get that first round of investment, or any round of investment, a big part of the diligence is the investor wants to make sure that the company actually owns all the technology. And a key component to making sure the company owns all the technology is make sure that there are agreements in place for everybody who's ever written code for the company, making it explicitly clear that the code that they're writing belongs to the company and not to them personally. And if
Brett, I'm not going to write a Medium piece about the PIAA that I had to go get from that a buyer's council gave me to a former employee who was pissed that she or he wasn't paid enough 5 years ago. So imagine how that conversation went. And I won't write a Medium piece about that.
Yeah. So, but point is, to you founders in the audience, get those things in place from day one. It's really easy to in the early days, you got all your friends helping to write the code, and everybody's excited, and everybody's sitting in their office at Google, writing code for the startup, in their spare time. And later on, that's going to be a big, big issue if it turns out that all the IP the company has is not clean. So, and we've got a quick question coming in on this topic, so let's look at this since it's on topic. If the IP belongs to the founder, does it make sense for the founder to get his or her own counsel? Well, Louis, you want to speak to this?
Well, I'm going to ask SC, if she would ever invest in a company where the company doesn't own the IP, it just licenses it from the founder. I think the answer is NFW.
Yeah, you're totally right, Louis. We would never do that. I will add that I have seen companies that are at this super early stage and have lengthy conversations about, do I assign this or do I assign that? Do I keep this? Do I keep that? None of them are ever really successful, because what makes you successful as a company is you're all in. And if you're, 1 foot in, 1 foot somewhere else, you will not have the drive to make your company successful. So if you're a founder and you're debating whether to assign to a company or not, maybe don't start the company. Or if you have a co-founder that's debating whether to assign a patent or not, maybe they're not the right co-founder.
Yeah, in my experience, this would be a giant red flag. That would be a deal killer. Yep. So let's see. We've got about 5 more minutes. So, Jenny, additional thoughts that you have on the financial side? Because I've seen a lot of deals fall apart because the financial statements just turn out to be a rat's nest.
Yeah, it does happen. So what I emphasize the most with the founders whenever I have the initial meetings is just deferred maintenance. If you're behind, just catch up. Yeah, just catch up now. It's like a house, right? You're just building the house right now, and some things you're behind, just catch up as soon as possible, and be willing to make the investment in terms of money, in terms of resources, in terms of your time, right? And it's not that hard. And some founders may have a mental block, like, hey, this is finance accounting. I don't want to know. I don't need to know. But you are the founder, you are the CEO, you are the owner of this business. The person will advise you and educate you. Just try to be open-minded and learn something about it, right? So that sense of ownership is important. Deferred maintenance is important. And once you get caught up, try to maintain the momentum, right? And in terms of controls, in terms of processes, books get closed on a monthly basis. I want to see my financials day 6. That should be done, right? I want to check off. I want to see KPIs. I want to see cash balance. I want to see my hiring, all that. Just get into the rhythm. It's like going to the gym, get into a healthy habit, right? Same thing for financial reporting.
Yeah, I think that's really good advice. So those of you in the audience who are engineers know that technical debt is a trendy term that basically means that you're writing code in a hurry, and a whole team writing code in a hurry, and everybody's patching stuff together with duct tape, and thinking to yourself, well, I'll go back and clean that up later. I'll go back and clean that up later. And that technical debt tends to accrue, right? And so most good engineering teams are addressing the technical debt, on a monthly basis so that it doesn't accrue. And I think Jenny makes a really good point, which is apply that same sort of process to the financial side as well. Because it's a whole lot easier to keep it clean than it is to make it clean after it's a mess. I think my mom said that about my room too.
I said that to my kids too. Socks drawer, right? Like, where's the other pair?
Right. So, SC, as we wrap up, I was thinking as I followed along at the Theranos trial, the Elizabeth Holmes trial, I have to say that I was not so surprised at the fact that Elizabeth Holmes was out there overpromising a little bit, because that's what great entrepreneurs do. I was more surprised at how little diligence a lot of the investors did. I mean, there were family offices that wrote $50 and $100 million checks on the basis of one meeting, and no formal diligence process. So, what's your as a professional investor, kind of how would you sum up to others on the call who are investors? How would you sum up kind of how to approach the diligence process in a way that's productive for everybody?
I think it's two things, maybe. One, what I was saying earlier, if an investor writes you a check without doing due diligence, it tells you what they'll do when you need their help, right? So the more involved someone is up front, right, the more thorough they are about evaluating the risk they're taking, the more helpful they're going to be down the line, right? Like, it's sort of thinking about, are you dating 1 million people and therefore you don't care a lot about them? Or are you married to one person and you're deeply committed to them? It's the same thing. So that Warren Buffett versus, a random investor analogy, very important. It matters very much on the other side, right? When you're, for example, trying to sell your company, because, or exit. And I'm not going to talk about Theranos. Obviously, it's a one-off crazy scandal. But I'll give you an example of an entrepreneur who took not dumb money, right? Not smart money, even put them on their board. And then when he was presented with two competing acquisition opportunities, which could have been life-changing for him, his board didn't know how to handle it. His board was somewhere on a yacht or whatever, his board members. And so this entrepreneur, who was a first-time entrepreneur, didn't know how to handle it, didn't know that they could hire a banker, didn't know they could talk to lawyers to try to put these two offers in competition, get better terms, and they ended up not being able to exit. So what you see at the due diligence stage, where an investor is using the due diligence process to get to know you, use that to also get to know them. If you see that they're asking you a lot of questions, they're very involved, it means they're actually sophisticated. So when it really matters to you and they're on your side, they will be very helpful to you.
It's really great advice. Diana asked a very quick question about about my Theranos example. And Diana, I think the answer is that, so most investors that I've dealt with, as part of the diligence, they want to talk to your 5 largest customers. It's kind of a common request. I'd like to talk to your 5 largest customers. And I think that if the Theranos investors had asked to talk to some of the actual customers, they would have found out that these machines didn't actually work quite as well as Theranos claimed they were working. I'm not an expert
Can
in this, but that's
can
my
I add something?
Yeah, please.
It's so ezy to point at the one-off, right? Oh, look at this dumb person who put money here, or this it's so easy to do this. What this whole story in the news is showing is not showing are the people who, for example, did due diligence and passed because they saw that there wasn't enough customer references and so on and so forth. So whatever you see in the news, whether it's a big Theranos scandal or whether it's this company raising like $10 billion with no revenue, it's entertainment, right? Like, you're running a business, you're here to build something amazing, you're here to change the world, and it's not easy. It's not going to, come without risk, and it's not going to come without amazing rewards. But all that stuff in the news, I would say, great entertainment, but not really relevant to you building an amazing business.
Great. Those are wise words right there. All right, Louis, I think we'll wrap this up. So you want to have the last word on this?
I think what my takeaways from this discussion is that you really need to have a great advisor team as you set out to build your company. And there's your team around you that are building the product, but outside of the company, you need to have a very strong legal function that works with a lot of startups, that understands the problems, that can address them at scale with technology-enabled tools, and hopefully has a great network of other strong advisors like Jenny, who helps companies with their finance function, and investors like SC, who when they dig in, they really dig in. They're invested. They're there for the long term, and are going to be great references when you go raise your next round of capital, who also have a network of customers and marketers, like Products That Count, that's associated with Mighty Capital. So, and obviously, Brett, it often starts with you, the coach, who helps put the team together. So it's a real honor to have this group, and they're all people that I personally talk to about all of these issues. And I look forward to getting a group again together on April the 5th, Brett, to talk about founder equity and getting those arrangements right.
Yeah. Optimizing founder equity. That is going to be the topic of our next discussion. And it's a big one for founders everywhere. Every founder wants to raise money, but also wants to, preserve their equity. So how do you balance those two things? And we'll be talking about that on April 5th. All right, guys, thank you so much. This has been a terrific discussion. I've enjoyed it a lot. Hopefully it was helpful to our audience. SC, great to see you again. Jenny,
Great
always
to
a
see
pleasure.
you. Thank you, Brett and Louis.
Yeah. Thank you.
Louis,
Brett.
thanks
Good to see you, Jenny.
for this. See you guys.
Thank you, everyone.
Thanks, everyone.